Hello everyone, welcome to BISP Solutions. BISP Solutions is a tech company that provides technical solutions across the world. So in today's session, we will be understanding about the financial modeling. So in our previous session, we have covered DCF modeling, terminal value, types of terminal value, exit multiple method, difference between Gordon versus exit multiple, how all this headings are linking with financial modeling, and understanding risk, cash growth, and three golden rules of DCF modeling, and what data do we need for WACC. So now we will be starting with our WACC importance, formula, risk averse investor, marginal return, beta, regression approach, bottoms up beta, and mean reversion and beta drifting. So in today's session we will be discussing about these. So starting with our what is WACC. As we know, WACC stands for weighted average cost of capital. So first of all, what is WACC? It is the average rate a company pays to finance its assets using both equity like shares and debt like loans. It tells us how much it costs the company to borrow or raise funds. Next is our why is WACC is important in financial modeling. So in financial modeling, WACC is used to discount future cash flows in DCF analysis to know the present value of a company or project. It's like the company's expected return or minimum hurdle rate. So the basic formula for the same is WACC is equals to E divided by V into RE plus D divided by V into RD into 1 minus TC, where our E is equals to market value of equity, D is our market value of debt, V is equals to E plus D, which is total value, and RE is our cost of equity, where return expected by shareholders is there, RD is cost of debt, where interest rate paid on loans are there, and TC is our corporate tax rate. So in simple words, we can say a company has a mixture of money from owners' equity and borrowed money, which is debt. WACC tells us the average cost of this money. So lower the WACC means cheaper capital, which is good for the company. Let's take an example. If a company is financed 60% by equity and 40% by debt, so cost of equity, which is RE, is equals to 12%, cost of debt is 6%, and tax rate is 30%. Before moving ahead, we have already calculated this in our sheet also, that if we take WACC formula, so we can calculate our WACC for the same. So this was the capital structure, which is showing equity versus debt, where 40% is our debt and equity is our 60%. So the company must earn at least 8.88% on this investment to satisfy both its lenders and shareholders. So next is our steps of the explanation of the same. For example, a hypothetical situation I am taking, like Karthik's dream cafe is there, so he need 10 lakh rupees, but he has not that much amount with him, so he has taken 4 lakhs debt and 6 lakh rupees from savings. So if we total this, it will be coming as 10 lakh rupees. So equity was 60% and debt is 40%, and total was our 10 lakh, and return per year he is expecting is around 12%. So if we put our formula and put our values in this formula, so then we will be getting 8.88%. So this means on average, the cost of using both his savings and borrowed money is 8.88%. So his cafe must earn more than 8.88% profit annually for the business to be worthwhile. So just like Rahul wants a return on his savings and needs to pay interest on loans, companies also equity and debt and use WACC to decide if a project is profitable or not. So WACC is like the minimum return Karthik needs to justify the risk and cost of starting his cafe. For companies, it's same, the benchmark returns for investment. So in this steps also Karthik's capital mix and cost of each source and calculating WACC, which is 8.88%, which we have calculated in our sheet in our previous session also. Then comes our cost of capital, which consists of two, which is cost of equity, cost of debt, and WACC. So cost of capital is the return a company needs to generate to justify the money invested by its investors. It consists of two main parts, equity and debt. So cost of equity is the return that equity investors expect from investing in the company. For that, formula will be used as cost of equity is equals to risk-free rate plus beta into market return minus risk-free rate. Then comes our cost of debt, which is the effective rate of interest a company pays on its debt. So for that calculation, so we will be taking interest rate on debt into 1 minus tax rate. After that, risk-free rate, which is return on an investment with no risk of financial loss. Example, government bonds, which are very risk-free, and we get a certain return percentage on the same. Then comes our types of investors based on risk. So first is our risk averse investors who prefers low risk and is okay with lower return. For example, retired people investing in FD. Then comes our risk avoider investor, where they try to completely avoid risk, prefers guaranteed returns. For example, someone who puts all money on only in his savings account, like that. Then comes our marginal return, where additional return earned from one more unit of investment, like extra return from investing an additional $1,000 in advertising. So for an example, we are investing 1 lakh rupees and getting 10,000 rupees in return. So then investing another 1 lakh and getting 8,000 rupees, then 8,000 is our marginal return. So it is lower than before we are getting. Next comes our dividend yield, where company's total annual dividend payments dividend by its market capitalization, assuming the number of shares is constant. It is often expressed as a percentage. So for that, formula is dividend per share upon market price per share. Buyback yield, where return given to shareholders when a company buybacks its shares. So for that calculation, we will be doing buyback amount upon market capitalization. Then comes our total shareholder return. So it represents the collective group of owners of a company's stock or shares. It is knowing that the number of shareholders can provide insights into the company's popularity, the distribution of ownership, and the potential for shareholders' influence. Then comes our beta, which is, it refers to the modulation index, which is the ratio of the frequency deviation, which is denoted by delta F, to the modulating frequency, which is Fm. So it essentially quantifies how much the carrier frequency deviates from its center's frequency due to the modulating signal. A high beta value indicates wideband FM, while a low beta value indicates narrowband FM. So actually beta tell us how risky a stock is compared to the market. So if beta is equals to 1, so same risk as the market is there. If beta is less than 1, so it will be more risky, and if beta is more than 1, it is less risky. So for an example, if Nifty goes up by 10% and a stock goes up by 15%, its beta will be more than 1. So there are two ways to find beta. First is our regression approach, where it uses historical data of stock versus market. So for that, we will be calculating it by the formula y is equals to a plus bx. So y is equals to, y is stock returns, which is dependent variable, and market return is x, which is independent variable, and b is our slope, which is beta. So it means like whenever we make a graph like this. So our this is y and this is x-axis for us, right? So what we will be doing, again using marker, so this x is our independent variable and this is our dependent variable, right? So it means, like, let's suppose we are marking over here 3 parts. So now this is our sales and this is our profit, right? So what is there to understand? That if sales is increasing, like suppose 10 is there, 20 is there and 30 is there, right? So now understand one thing, that if sales is our one, let's suppose, then our profit will be 20, right? Because y will be working upon x, whatever x will be telling y, then only that will be the thing y will be doing, right? If x or sales is a 30, or we can say 2, and our profit is 30, like that only. If our sales is, let's suppose 3 and it is reducing by 20, these are in percentage, okay? These are in percentage and this is our in times, right? So what it will be showing us, let's suppose make it as a graph. So we will be having our slope like this. Sorry, it will be increasing from this to this. Just a second, removing it. Our graph will be like this to this. So what is this? This will be our slope. So we can number it as slope. So this slope is included in our regression. So this is what our regression approach is about. So if we talk about our bottom up beta, which is starting with industry average beta, adjusting it based on company's capital structure like debt upon equity, and more stable and less noisy than regression beta is there. It means it is calculated using average beta of peer companies where industry average is there, useful when company is new or has little trading history. Then terms which are involved in calculation of beta, First is our raw beta, where it is directly from regression. Then is our market beta, where beta assumed to be 1 for the entire market. And beta drifting, beta changes over the time due to new data. And adjusted beta, which is smoothens raw beta towards market beta, where adjusted beta can be calculated as 0.67 into raw beta plus 0.33 into 1. Then comes our market returns, where average return from the overall stock market, for example Nifty 50, like this the graph will be shown to us when we are calculating our market return, and we are depicting it with our line chart. Then mean reversion is over the time high returns fall and low returns rise toward the average. So if a stock with abnormal gains may return to its average performance, it is called mean reversion. Then comes our retained market. So it refers to the company's ability to hold or grow its share in the market. It means like if we open a business, right? So how much customers we are able to hold and how much customers are not happy with our services or products we are selling, we have to make a full analysis on the same thing. That is what retained market will be calculated upon. Then comes our beta regression, where beta regression is a statistical technique used when the value you are trying to predict is between 0 and 1, and it is not related to beta in CAPM, which is capital asset pricing model, although the word beta is used in both the terms. So why not to use normal regression, where regular regression like linear regression works best when the output is a number that could go from minus infinity to plus infinity, but in some cases the outcome is always between 0 and 1, like conversion rate, percentage of savings, probability of attending a class, like that. Now take an example for the same. If we open a new over here, so our first is our about healthy eating. Proportion. So what it means? So it means the question arises on this same thing is what percentage of our food in a day is healthy for us, right? So now if we want to predict for the same, like how much of someone's food is healthy, like in the scale of 0% to 100%, and based on things like age, income and working hours. So this is what the question arises. Then we will be understanding it by prediction target. which means range is between 0, which is 0%, to 100, which is 100%. Right? So here we will be using regression of beta, right? So in this, why we are using it? Because our result may be stay between 0 to 1. This is what our beta regression is all about, right? So if we take a example, before moving forward to our beta regression, what we will be doing a calculation which we have done in our previous session also. Till average and median we have calculated for our weighted average cost of capital. Now if I want to calculate my cost of debt, and I have to take hypothetical situation. So first of all, pre-tax cost of debt I am taking as 8.40%, and tax rate I am taking as 30%. As we know that 30% is for long run companies, so they have taken tax rate as 30%, so we are taking it as tax rate as 30%. You all can take as 20% also, but I am taking it as 30%. Now if I want to calculate my post tax cost of debt, so what I will be doing, I will be doing multiplication of pre-tax cost of debt into 1 minus our tax rate, which will be giving me a number 5.88. Now my cost of debt is calculated. Now if I want to calculate my cost of equity, I have given a hypothetical figures for my risk-free rate, which I am taking as 6.50, and equity risk premium as 8.50. Now if I want to calculate my levered beta, I have to link it with my levered beta, which I have calculated separately. But before coming to my cost of equity, I will be doing a calculation of capital structure, where I am taking total debt, where my current total debt and target total debt will be there. So let's say I am taking 17,440 as my total debt, and I have taken market capitalization as 32,265, so the total is 49,705. Total capital with us is our 49,705. Next, we want our current and targeted total capital to be 100. So if I am calculating my total debt, so I am taking my total debt, which is divided by the total capital, and I am giving it absolute anchoring, and when I enter it, it will be showing me 35.09% current debt, total debt. And if I want to calculate the same thing, I have to drag the same calculation, and it will be giving me 100% only. Then if I want to calculate my target, so I am taking a total debt of 42.50, and then I have done a subtraction because we want 100%, and I have my target total debt as 42.50. That's why I have taken 57, I have subtracted it, and it is coming as 57.50. Next is our debt upon equity, where I am taking as current and target. So for that, what I am doing over here, I am calculating it by taking current, which is total debt, upon total liability. So it will be giving me 54.05, and if I want to reduce the decimal size, I can do it by this. Then comes our target, so I have already dragged it till the end, so it is giving me 73.91%. Now coming to our cost of equity, So risk free rate I have taken, equity risk premium I have taken hypothetically. Now my levered beta is remaining, so for that I will be doing a calculation of levered beta, where I have taken comps median unlevered beta. So I have taken it from my median beta, unlevered beta, which is 0.05. So I have taken over here. Then I want to calculate my target debt upon equity. So my target debt upon equity is my 73.91. So I have taken over here. And tax rate I have taken 30% in my above table also. Then I have calculated my levered beta. How I have calculated it? I have calculated it by comps median unlevered beta into 1 plus 1 minus tax rate into my target debt upon equity. Then I will be getting my levered beta, and that levered beta I will be linking it with my cost of equity. So if I want to calculate my cost of equity, I have calculated by risk free rate plus equity risk premium into our levered beta. Then we will be getting cost of equity for us. Now I have calculated my cost of debt, capital structure, and cost of equity, levered beta, and now the remaining part is our weighted average cost of capital. So for calculating it, I have taken two heads only, which is debt and equity. So I will be calculating it as total cost, where I have taken my debt, which is 5.88. So I have taken it from my post tax cost of debt, and my equity, which is 7.11 percentage. So I have taken it from my cost of equity, like here. Now I have to calculate my total weight. So for that I have taken my 42.50, because I have calculated already over here, and I have linked it. Then my equity, which is 57.50, it will be linked from my market capitalization, which I have calculated in my capital structure. And now if I want to calculate my weighted average cost of capital, I have taken a formula of some product, where I have taken my total cost and total weight, and when I calculate it, it will be coming as 6.59%. Now like that only we will be calculating our weighted average cost of capital. Now moving forward to our beta regression. So how to calculate that? Before moving towards our beta regression, we will have to do one thing. We have to go to our screener.in, and before opening screener.in, we can do one thing. We can take our data from investing.com also and Yahoo Finance also. So in this Yahoo Finance, we will be getting all the data. I want my Hindustan Unilever. So before over here, so this is my Hindustan Unilever, and again I will be doing a duplicate tab, where I will be taking my Nifty 50 data. So here what we have to do, we have to select our data, historical data, and now it is showing us currency in INR. What we have to do, we have to check our historical prices weekly, first thing, and second thing, we want it for 2 years. So let's suppose I am taking 2021 till 2023. and when I click on done, so it will be showing me the data from 2021 till 2023, and it is a weekly data of our Hindustan Unilever. Now if I want Nifty 50 returns, so it is showing me historical data, so I will be clicking on historical data, and again the same process will be done, like we have to change from daily to our weekly, and here we have to type 21st and here we have to type 2023, because we have to maintain clarity of dates between both. And now we will be copying the two companies data. Now what I have done, I have taken the data and it is coming to me in the form of, like suppose there are two ways for getting data. First, you can copy it from Yahoo Finance, and investing.com is the another site where we can do one thing, like Hindustan Unilever I have typed. So in both the URLs and both the place, the data will be same. So just a second, it is opening. Yeah, now what we will be doing, we will be going to our historical data. We can do copy pasting from here also, and here also we can do. So what I want weekly data, right? I want it from 2021 May 28, and here from 2023 May 28, and when I click on apply, it will be changing from 21 to 23, and when I download it, so it will be giving me a different Excel sheet from where I have to take date and my adjusted closing balance for my Hindustan Unilever and Nifty 50. I have done my editing for these two companies so that I get a better understanding for the same. So for that, what I will be doing, I will be taking date which is same for our Nifty 50 and our HUL. So I have taken my data, then I have taken my adjusted closing balance. So I will be taking this data over here and will be doing copying pasting it. Now if I want to calculate my returns, so I will be doing one thing, I will be dividing my May 1 2023 from my May 8 2023 and -1. So like this. So in some parts it is showing us value. Why? Because it cannot be calculated. Sometimes it happens because of some issues in Excel. So we can do one thing, we can do manual entry like 2454.60 divided by our 2417.58 -1. So it will be showing us this. Again, if we do this thing, so we have to change 2482.72 over here and 2454.60. 58 we have to remove. Okay, now this is it, and same thing here also we have to do. We have to calculate it as 2434.57 divided by 2404.28 minus 1 equals to this divided by, if we will do the same thing, it will show us the value option only. So for some data we can do manual entry also, which is divided by 2434.57, which is subtracted by 1. So this is what our returns is all about. Then what I will be doing, I will be selecting this whole data over here and convert it in percentage. Now I will be having 2 decimal places, and this is what my returns will be. So I will do a formatting for the same, because all the data is in formatted already, and these two will be on the right side. Sometimes when we copy our details, or we can say our data, so it might show us some issues, and it is really very okay if it is showing. Then if we go to our date, again the same date will be copy pasted from this. What we will be doing, we will be taking whole data like this and selecting this to left and this to right, and returns should be on right, and whole data will be on right. So again the same function, -1, control plus C, and dragging it till the end of the table. So it is not showing us value. We have to check again and again so that it is not showing us errors. So this is what our returns for our Nifty will be about. So this is our HUL's data, this is our Nifty 50 data, weekly returns, and now the main part is our beta calculation. First, how we can calculate our beta. We can do it by taking function as slope, and we will be doing just a second, like this. We have selected, then we will be taking our Nifty's weekly return. So it is taking only one. Again we have to select the table over here, and closing the bracket, and now it is showing us beta, which is 0.030. Now if I want to calculate beta through second method, so what I have to do, I will be using my covariance sample, where it is asking me array 1, where I will be taking the same data from this. It has taken so less data, so again we will be selecting the whole data again, and again going up, then taking this data over here and closing the brackets. Then we will be dividing it by variance, which is of sample only, and again we will be taking our return of Nifty only and closing it, and then our so this is coming in percentage. So yeah, this is our second method to calculate our beta. Now third method to calculate our beta is when we have our first session. I have already told you all about installing tool pack. That's why only we will be getting this option under our data. So once we click on data analysis, it will be showing us a small box and we have to select regression. Then we click on OK. After that, it will be asking us our X range is our HUL and our input Y range is Nifty and output range over here we want, and okay, now it is showing us a small data sheet where everything is calculated. So this is how we can do calculation of beta. Then if we want to take our beta from here, so again doing that, we have done a small mistake over here, again calculating it as returns. Let's say I'm taking this and everything will be right like this, right? So our beta is coming as 0.30 in this also, like this. Previously we have selected wrong data set to calculate it. So this is how we calculate our beta in 3 different forms. So we just have to highlight it little bit like this and right. So if we want to see beta drifting, so for that we will be taking our levered beta. So for that we will be doing 1.24 into which is this. So it is coming as 0.372502. Now I am taking my raw beta as 0.75 and I will be doing a hard coding here. So I have changed the color. Now market beta I have to calculate, so I am taking it as 1. So this is my, this is also in number, right? This is also in hard coding. And mean or market weight we have to calculate. It will be around 0.25, let's suppose. It will be on this guy. Now if we want to calculate our adjusted beta, so we will be doing the calculation as we have saw in our PPT also, that we will be taking our levered beta, which will be into raw beta weight, then closing bracket, then plus, then we will be taking market beta into our market weight, and done. This is what our adjusted beta will be. So this is how we make our beta regression in our financial modeling. So I hope this session gave you clarity and confidence to take your first steps or go deeper into the financial modeling. So keep practicing, stay curious, and remember, real insights come from working with real numbers. Until next time, stay financially sharp and analytically strong. See you in the next session. Thank you.